Most people say investing is risky, but what if the real risk is never investing at all? Inflation quietly eats your savings, expenses rise, opportunities pass. And while you're trying to play it safe, your money slowly loses power. The truth is, avoiding investing might feel comfortable, but staying broke is far more dangerous in the long run. In this video, we're breaking down why investing isn't the gamble most people think it is, what real risk actually looks like, and how smart investing protects your future instead of threatening it. The real risk is doing nothing. People think keeping their money in a savings account or under their mattress is the safe move. But think about this. If inflation is running at 6% a year and your savings account is giving you 1%, you are actually losing 5% of your purchasing power every single year. That money you saved up over 5 years, it buys less today than it did back then. This is not a theory. This is happening to millions of people right now who believe that not investing keeps them safe. The truth is, sitting still in a world that keeps moving forward is the riskiest thing you can do. You are not protecting your wealth by doing nothing. You are watching it shrink in slow motion. The market goes up and down, yes, but over time, historically, it has always trended upward. The real losers are not the people who invested and saw some short-term dips. The real losers are the ones who never started at all. You do not need a lot of money to start. One of the biggest myths out there is that investing is only for rich people, that you need thousands of dollars before you can even think about it. That is completely false. Today, you can start investing with as little as $10 or $20 using apps and platforms that let you buy fractional shares. The barrier to entry has never been lower. The real question is not how much money you have, it is whether you are willing to start. A person who invests $20 a month consistently for 20 years will be in a far better position than someone who waits until they have $1,000 saved up and never actually gets there. Compound interest does not care how much you start with, it only cares that you start. Every month you wait, you are giving up time, and time is the most valuable asset in investing. Rich people did not just invest because they were rich. Many of them got rich because they invested early and stayed consistent. The habit matters more than the amount, especially in the beginning. Understanding risk versus being afraid of it. There is a big difference between understanding risk and being so afraid of it that you never act. Smart investors do not avoid risk, they manage it. They diversify their portfolio so that if one stock or sector takes a hit, the rest of their investments cushion the blow. They invest for the long term so that short-term market swings do not wipe them out. They educate themselves so they are not making emotional decisions based on fear or hype. Risk is part of life. Every time you start a business, change a job, or make a big decision, you are taking a risk. The key is not to run from risk, but to understand it and work with it. The stock market, index funds, real estate, and other investment vehicles all carry some level of risk, but they also carry potential that a savings account never will. A person who learns how investing works and makes informed decisions is not gambling. They are building. Fear of risk is understandable, but letting that fear keep you broke for decades is a much worse outcome than facing a temporary dip in your portfolio. What staying broke actually costs you. Let us talk numbers for a second. If you invested just $200 a month starting at age 25 with an average annual return of 8%, by the time you hit 65, you would have over $600,000. Now, if you wait until you are 35 to start, that same $200 a month gives you around $270,000, less than half. That gap is not because you invested less money. The difference in total contributions is only $24,000. The real gap is caused by lost time. The 10 years you waited cost you over $300,000 in potential wealth. That is what staying broke costs you. It's not just the money you don't have today, it's the money that money would have made, and the money that money would have made after that. Every year of inaction is a year of compound growth you will never get back. People often say they can't afford to invest, but when you look at the real numbers, the truth is they can't afford not to. How to start even when you are scared. If you're new to investing and the whole thing feels overwhelming, that's completely okay. Almost everyone feels that way at the beginning. You don't have to figure everything out on day one, and you definitely don't need to understand every chart, term, or strategy before you begin. Start simple and focus on the basics. Open a brokerage account or a retirement account like an IRA or a 401k if your job offers one. If your employer provides a match on your 401k, try to contribute at least enough to get that full match. That is essentially free money. Once your account is open, put your money into a basic index fund that tracks the overall market, something like an S&P 500 index fund. These funds spread your money across hundreds of companies automatically, which reduces your risk and removes the pressure of picking individual stocks. You are investing in the growth of the entire market, not betting on one company. Set up automatic contributions so the money moves before you even think about spending it. Automation removes emotion from the equation. It turns investing into a habit instead of a decision you have to make every month. Then leave it alone. Do not check it every day. Do not obsess over headlines. Do not panic when the market drops, because it will drop sometimes, and that is completely normal. Markets go up and down in the short term, but historically they trend upward over the long term. What matters most is that you stay in the game. Consistency beats intensity. Read books, watch videos, learn as you go, and slowly build your understanding. You do not need to be an expert to start. You just need to start. The more time you spend waiting until you feel ready, the more time you lose. And in investing, time is your biggest advantage. The mindset shift that changes everything. At the core of all this is a mindset shift. Most people see investing as spending money, but wealthy people see it as putting money to work. When you invest, your money does not disappear. It goes out into the world and comes back with more. Every dollar you invest is like hiring a worker who works for you 24 hours a day, 7 days a week, 365 days a year, and never asks for a day off. The problem is that the broke mindset tells you to hold on to every dollar out of fear. The wealthy mindset tells you to deploy every dollar strategically. This does not mean being reckless, it means being intentional. It means understanding that money sitting idle is money slowly dying. Once you start seeing your investments as your money working for you rather than money you might lose, the entire game changes. You stop seeing investing as risky and start seeing it as the only logical move. Because when you zoom out and look at the big picture, the only truly risky financial decision is choosing to never invest at all. Risk isn't about movement, it's about stagnation. If this changed how you see investing, hit like and subscribe for more practical money insights. And watch the next video to learn simple investing principles that reduce risk while building long-term wealth.